This is question number 35 of the midterm exam. If you were to use the standard deviation as a measure of investment risk, which of the following has historically been the highest risk investment? A. Common stock of large firms. B. Long-term government bonds. C. U.S. Treasury bills. D. Common stock of small firms. So to answer this question, basically we need to have some common sense about the relative risk characteristics of the common types of securities. So, for example, bonds and stocks, right? We know that generally speaking, stocks are riskier than bonds. So if you understand that common sort of perception, then you can immediately rule out B and C because both B and C are bonds, and especially C is a very short-term government bonds, which is treasury bills. The maturity is less than 1 year. Actually, mostly less than 9 months, I guess. Long-term government bonds, that's riskier, but still that's bonds. So relative to stocks, they are less riskier. And so we are left with A and D. So and then um, the common sense should be that small companies should be riskier compared with large companies, right? So if we understand that, then obviously only D is the correct choice. And also we talk about this in the book and in the class by if you look at the historical numbers for the standard deviations of these four different types of securities, you can also see that small company stocks has the largest standard deviations, largest standard deviation, which means that it's the riskiest among these four different types of security classes. So that means only D is the correct answer.